Good afternoon, everybody, and welcome to the first food and drink webinar of the 2014 Open to Export Food and Drink Calendar. My name is Gemma Price. I'm the Content and Community Manager at Open to Export. For those of you that don't know, Open to Export is a free online community for UK businesses looking to sell their products or services overseas. We are proud to be supported by our founding partners, UK Trade and Investment, the Federation of Small Businesses, the Institute of Export, and HIBU. Today we're going to be looking at how to scale up your food and drink exports. We have an excellent lineup of panelists and industry trade associations that will go through the considerations when upscaling your exports. Just before we get into the main presentation, I'm just going to cover off a little bit of housekeeping. So our runtime today is 1 hour, so we'll take us through to around about 3:30. And you can communicate with the panel and put your questions to the experts using the chat box or the questions box in your control panel, which should be on the right-hand side of your screen. Now, we are also following the conversation intently on Twitter, and you'll see at the bottom of the key slides, there's the hashtag OTE food and drink. So do tag us in any of your tweets so we can keep the conversation going. Now, this entire webinar will be recorded and uploaded to our YouTube channel in the coming days, and we will email you out the link when that is live. So there's no need to take notes. A copy of the presentation will also be available. We've got my colleague Matthew manning the chat box and moderating your questions as they come in. We've got a dedicated kind of 10 to 15 minute Q&A slot at the end, so we'll get to as many of your questions as we can. What I'm going to do first of all, just while we wait for the last few attendees to come onto the session, I'm going to run a quick poll now. So you should see that come up on your screen. So the poll for those of you that are on the dial-in is what is the biggest challenge you envisage when considering upscaling your exports? So if you could choose from the options on screen and the one that's most appropriate to your business. Again, for the benefit of those that are just using the dial-in details today, I'm going to verbally call them out. So the options are manufacturing capacity, the skills and knowledge, your human resource levels, finance and cash flow considerations, or of course the regulation and paperwork side of things. So while that's running then, I'm just going to introduce our first expert of the day. We're lucky enough to have Steve Barnes from the Food and Drink Federation with us. He's the commercial director there, and he's going to take us through some kind of industry insight of what's going on in the sector at the moment, and also expand a little bit on our plans of activity for the coming year. So I'm going to close that poll now and share the results with you, so you should see that come up on your screens. Interesting, regulation and paperwork is the main consideration at 41% now. Again, all of this will be on the YouTube video, so don't worry if you can't make a note of it, and we'll make sure this slide is available to you all after the session as well. So what I'm going to do now is hand over to Steve. Steve, are you with us?
I am, Gemma, thank you.
Fantastic.
Interesting results. No one obviously likes paperwork, least of all me. But good afternoon, ladies and gentlemen. And welcome to everyone who's joined the webinar this afternoon. Really pleased that you're with us. As Gemma said, I'm Steve Barnes, Commercial Director of the Food and Drink Federation. And FDF exists to represent the interests of food and drink manufacturers across the UK. We're proud that we've been working with Open to Export for the past year and a half. Next slide. I just wanted to give a very brief overview of the food and drink manufacturing industry, and just a flavour of some of the opportunities and challenges that we have. Food and drink is the largest manufacturing sector in the UK. We employ 400,000 people, 3 times as many people who work in the car industry, and we have 8,000 individual businesses operating in this sector, again 4 times as many as exist in, for example, the car industry. So we're a huge industry, and we have a vast variety of sizes of businesses operating in the industry, both large and small. In terms of exports, food and beverage exported over 19 billion last year, which is a phenomenal figure. And despite the EU being in recession at the start of the year, UK food and drink exports grew to EU markets by 3%. But our strongest growth came from the non-EU countries at 12%. So our products are in high demand. And exports, particularly of value-added food and drink, so if you like branded goods, have doubled in value since 2003 to 10 billion a year as a result. And British food and drink is perceived as good quality and safe to global consumers. And I think despite what sometimes we may think when we're on the back end of the food scare in the UK, actually globally, UK food and drink enjoys a phenomenally high reputation for provenance, for the authenticity of ingredients, and for the safety of the products we're producing. So lots of positive things associated with the UK as a brand, but despite this, only 10% of food and drink businesses are actually exporting, which is a low number. And many of the companies that we find in our membership that are actually exporting are doing so reactively, so responding to inquiries and the web orders rather than actively selling and visiting international customers. So as a result, the majority of businesses that are actually exporting in food and drink are exporting less than 5% of their total sales. And that actually means as a nation we've fallen significantly behind our peer nations in Ireland, France, Germany, Spain and Italy, who all are exporting more as a proportion of their total food and drink manufacturing turnover than we do in the UK. So the Irish, for example, as a proportion of total turnover, export twice as much as the UK, and the French and the Germans 50% more. So if we could collectively close that gap, it would be fantastic news for individual operators and the industry as a whole. So why are we focusing now on finance and insurance? Thanks, Gemma. Well, I'm sure many of you are aware of the routes that are available to proactively grow an export business and what you need to do to support that growth, be it recruiting people with the right skills or finding the right experts for support or ensuring you have the production capacity to allow for increased orders or finding right partners in new markets. And for this, there are plenty of opportunities to find new business. There are trade fairs in the UK, such as IFE, there's Anuga in Cologne, there's CL in Paris coming up in October. And also just a quick plug, there is an export event being organised by UKTI on July the 3rd in Liverpool, which will be a fantastic event and an opportunity to meet buyers from international operators. If anyone is interested in attending that, can you just ping me an email on steve.barnes@fdf.org.uk and I'll put you in touch with the organisers. It's a free event. So there's many routes to actually grow your export business, but what members keep telling us is that they need to know more about how to protect themselves when exporting and where they can access financial support to help on the journey. Hence really why we're looking at trade insurance and finance today. We found that many of our smaller and even some of our larger members aren't really aware of the solutions that are available. So we've pulled together a team of experts that hopefully will help you on this journey. And we're going to start off by hearing from Susan Ross, next slide please, from Aon, who will give you an overview of some of the risks associated with exporting and some tips on risk management and insurance options to help protect and sustain a growing export business. Then we'll hear from Mark Hernamen at RBS on trade finance options available to food and drink manufacturers and how they can help you successfully secure and finance larger orders and reduce financial risk for all parties involved. And finally, we'll hear from Paul Wills from UK Export Finance to show you how government can work with both insurers and banks to provide finance and insurance to businesses that are finding it difficult to obtain support from their bank manager or broker. So next slide is just very briefly what our schedule is for this year. We're going to be running a series of other webinars. You can now register for our next webinar, Routes to Export Markets for Food and Drink, and further details of the other 3 webinars we'll release over the summer. And please join us for those. And in case you haven't already seen it, we have a food and drink open to export landing page where there's lots of information collated there, including our 10 steps to export success guide, which we developed last year. So lots of information already available, lots more to come this afternoon. And to start us on that journey, I'm going to hand over to Susan Ross. Susan, are you there?
Hello, Steve. Hello, everyone. Thank you very much for inviting me along. I'm just going to click the webcam, and there I am. Hello. I'm from the Aon trade credit area. So I'm looking at selling export credit insurance and domestic credit insurance to help companies to manage their payment risk. And a lot of companies actually use that to buy finance. So it's really very much in the 27% of you who are interested in financing cash flow. I also have another role in the British Exporters Association, and BEXA is a lobby group for export. And BEXA has, as Paul actually might refer to it later, has done a lot of lobbying to encourage UK export finance to provide better cover for UK companies, because after all, it's a competitive international marketplace. Next slide. Now, on this slide, you'll see this is way beyond me, really, these terminologies, but really it was so that you can see this view that actually it's this first step that's the difficult one. When you go from proactive to experienced, there's not a huge change in what you do and how you do it. I just want to mention on both the second and third boxes, there's attendance at trade fairs. Now, I've spoken to, in fact, a dairy exporter, and he is insistent that trade fairs should be approached very professionally. You need to go with an idea of who you're going to see. Set up meetings. You don't have to pay to have a stand. You have to know who's going to be there, set up meetings, times, dates, places, and then make a really good conversation with those people and come home with your jobs list as to who you're going to quote to and what they need. So don't just go potter along seeing who you can see. Do all the prep work first. Research who you're going to see, find them, contact them, make the appointments. Now then, the other thing that I just want to mention is experience. There's obviously no substitute for experience. Well, sort of. I would recommend meeting people in your own industry. The world's a huge place, and even your competitors are probably very happy to share some stories with you which will help you to learn about what's happening out in the world and different challenges that they've had and how they've solved them. So I would really recommend getting in touch with obviously the FDF and all that it's doing, but also any other clubs, export clubs, the chambers, you know, anyone who, particularly if it's free, you can meet people and just do the networking of how they solve their export issues. Next slide. So what are the risks? Well, I just wanted the first one, non-payment. And obviously, some companies do go bust. And I put Fresh and Easy up there. I don't know if you remember, that was the Tesco company in California that they pushed into Chapter 11 insolvency because the rent on all their leases on their properties were very high. The next picture is the dear old MV Napoli that went aground in January 2007 off the coast of Devon. It's quite a high risk cargo insurance because of the weather, because sea conditions. It's not always possible for the ship to avoid them. Then you've got shipping delays, next point. And of course, you're dealing with perishables. And then the last next one is goods stopped at port. That's all to do with documentation and making sure you get your documentation and your clearances and your health certificates and your packaging and everything accurate, because you're selling perishable goods and the last thing you want is for them to be held up. And the last one is cash flow. This is probably the biggest issue. You've got to pay your suppliers and you are waiting for cash from your customer. What you don't want to do is to rush home with the most fantastic new order that actually has the capacity to bring your company to its knees. Next slide. So it's a bit about the terminology. Trade credit, that's really when you're giving 30 days end of month for your customer to pay. That's just known as trade credit. And then you can buy payment protection, which will either be trade credit insurance, or you can perhaps go to a bank and get a factoring solution. Now, trade credit insurance is obviously what I sell, and I need you to know there's a dozen commercial credit insurers in the UK. There's also UK export finance, which Paul will explain later. The finance houses, the trade finance houses, they offer finance in a number of ways, but the one thing I will stress that you must ask is who's holding the baby if someone doesn't pay? So who's going to take the risk of bad debt? Is it you, in which case you need insurance? Is it the bank, in which case just check they've got insurance or how they're managing it? Just ask the question, because what you don't want is to have this lovely cash, the buyer doesn't pay, and then the bank has, or the finance house has the right to be repaid the advance that they gave you earlier. Product liability, obviously you've got product liability in the UK and you need to extend your policy. So get your broker to explain to you how the extension for the overseas market can be achieved, what you have to do to make sure that you're compliant with the policy, if there's any countries it's not going to work at. And freight insurance, cargo insurance, we just saw the Napoli there in the previous slide, absolutely vital. If you are using a logistics company, which you most probably are, they will offer this, and really just make sure it's from it's going to cover everything from your premises, your warehouse, to your customer. So the very few occasions when you need to go to an insurance broker and buy your own cover, but it's good to challenge the cover that you are being offered. Next slide. Now then, how to protect yourself against risk. What we're aiming to do here is to ensure a sustainable and growing export business. So on the non-payment, we mentioned trade credit insurance and payment protection through your bank. You could do a bit of work first, looking at who your customers are, get a credit check. It could be that you might want to restrict the credit that you provide. So instead of giving 30 days, is 7 days appropriate? And then on damage and loss in transit, obviously there's the insurance, but packaging plays a huge role. I'm sure you know all about that, and certainly your forwarder or courier logistics company should understand it as well. Here we go, shipping delays. A certain amount is just on the reputation of your carrier. But if the shipping delays are actually where the goods are stopped at port, that's to do with paperwork. And I'm afraid there's just nothing that you can do once that happens. So the thing to do is anticipate it. So do your research, find out how to get your goods into that destination country, and really ensure that you've done everything you possibly can to make sure that you are compliant with all standards, food standards, health standards, import duty. There's a huge difference, for example, on duty, whether you're selling to Norway or Sweden. Norway isn't EU, Sweden is. So your responsibility for paying duty stops at a different place. And if these customs officials are the same everywhere, they will assume if you've had a crash on the motorway that, in fact, the bottles of whiskey weren't damaged. They were taken away and resold, so they will go for the duty. So your insurance, if you've got duty on your product, your insurance needs to cover that wherever it's moving until you're no longer responsible. And the responsibility for Europe is destination. Responsibility outside Europe, so Norway, is actually on our shores. So lots to think through, but the logistics company will help you with that. Bottom right-hand corner, there is no insurance for goods stopped at port. Next point. Case studies. I just wanted to run through a couple of these. These aren't clients, by the way, but Ramsden International is the most wonderful success story, and do have a look at what they do. On the right there's their Christmas offering, and you've got to order, if you're abroad, you've got to order your Christmas goodies by the 3rd of July to get everything there in time. Ramsden is a very professional organization. They sell 23,000 grocery products to 120 countries. They are focused on what does their customer want. So they want to have the expats all over the world or people who are interested in the British products able to buy our products. And so they're really focused on everything: packaging, translations, delivery dates. Christmas is one of the festivals, obviously. Fantastic export story. The middle one is Juniper Green. It's London and Scottish. Is a father and son trading house established in 1993, and they work through country importers, and they're looking to have long-term relationships. Juniper Green is their classic. Was the only organic gin, and apparently it's fantastic. I don't drink gin myself. And the last one, do the washing up with this one. BM Polyco, founded 1979, and now is exporting 7 million. I sat through a talk at a seminar from the finance director of BM Polyco, and he said the difference, if you want to grow your export, you need to go professional. You need to take professional advice, buy credit insurance, get the finance sorted, and really sort of make the jump from the finance side, and then the exports will flow. He said no point trying to do it as a kind of homespun make do amend. He said you need to make that jump. We do have clients obviously in the food industry, and I'll just tell you about one of our clients who was domestic only, saw the opportunity in Spain, and used export credit insurance, and after 2 years their exports were up to £1 million in Spain. Next slide, please. I must rush through this because I don't want to use up everyone's time. Meeting the cash flow gap. I think it's really important to think through what's going to happen. You might have to give longer terms to your customers because it's further away. Collections can be more of an issue because it's not like you can drive by and go and have a coffee with the guy and ask him when he's going to pay. If the payment is a few days late, don't go carry on sending consignments. Just use it as a reason to take stock and call your customer. And then you've got this cash flow gap. So ask for longer terms from your suppliers because you're exporting. You may not get it, but it's for the sake of asking. Trade finance, obviously, factoring companies are there to close that gap. And the last point is credit insurance then gives the security to a finance house, so they will provide finance for your receivables where you have credit insurance. Next slide, the small print. We were talking about what happens if your documentation at the port isn't right. T's and C's, terms and conditions of sale. The battle of the forms, that's to do with you're sending your goods saying, these are my terms. The customer is buying from you on his terms. So you need to work through whose terms of sale actually apply. And it's worth getting a lawyer involved just to work through that issue with you. Your customer is a legal entity. If I say the word Smiths, we'll all have a different idea of which Smiths. It's absolutely crucial to tie down. If you're ever going to take your customer to court, you need to know their legal status. So do that investigation. Use Dun & Bradstreet, Experian, or whatever. Retention of title may not be any good if you're selling lettuces, but it's useful to have retention of title, because if your customer goes into some forms of insolvency, the insolvency practitioner will want to make a going concern, and therefore if you say, no, I want that stuff back, whether or not it's perishable, it just makes the insolvency practitioner think perhaps I do need to address early payment for some things. Customs and duty, have a look at the market access database. oh, sorry, I've gone from delivery terms. Have a look at Incoterms, which is the International Chamber of Commerce terms of delivery, so that you can decide. Most companies use free carrier. I'll leave you to look that up, but just hold in your mind free carrier because it's the fairest of all of those terms and delivery, and you're still in control. Customs and duty, take a look at the market access database on the EU website. I've got a couple of guides I'll point you to in a minute and to show you how to get there. But they'll tell you where we've got preference trade arrangements for customs. So that, for example, we set one up. Korea, Canada's coming, the States maybe one day. So where we've got preference arrangements, the duty, you may not have to pay any duty at all, whereas your competitors might have to. Labeling, that's going to go without saying in the food and drink industry. Last point is noting discussions and meetings. Just take notes. Have something on paper in a file somewhere so that you've got something to refer to if things don't quite go right. Prepare for the fact that not everything is going to go right all the time. And then I've put a little note on the bottom, back up your high standards in product quality with high standards in documentation. Get a reputation for on-time, hassle-free delivery. And then I've got, if you click once or twice more, Gemma, you'll get the food standards. There you go, the red tractor. I show my roots in the agricultural industry. Next slide, where to go for help? A couple of guides. I've had a look at the FDF guide that Steve was talking about just now. Fantastic guide. It gives you the pointers. You'll disappear from this guide to 100 different websites to help you get where you want to go. It's really simple, one idea on each page, 10 steps, wonderful. If you want something more detailed, there are two BEXA guides that I would really recommend. There's one on successful exporting, which I've got here, and the other is on export compliance, which tells you all about duty, customs, VAT, all of that. And on the right is just a screenshot of 10 steps to export success. And in there, you've got things like the wow factor, continuous product development, entering competitions, piggybacking and going faster, just as little tempters. Right, last slide coming up, where to go for help. And I think I'll sign off really because I think you'll be able to take this home with you. Thank you very much indeed.
Okay, thank you very much, Susan. Certainly you would agree that cash flow is a real challenge for any business, despite whatever size that business may be. So certainly a focus on cash flow. And thanks very much for the advice and pointers as to where to go to for further information. That was great. So now, without further ado, I would like to hand over to Mark. Mark, are you there?
I am. Thank you very much. Good afternoon, everybody. My name is Mark Hernamen. I'm Solutions Delivery Manager, International Trade for the RBS NatWest Transaction Services team. I've been invited to talk to you this afternoon about some of the practicalities, challenges and risks facing UK exporters operating in the food and drink sector and how your bank can help and support you with your export opportunities. If we could turn to the first slide, thank you. So in respect of the first slide, some factors to bear in mind as to some of the more practical aspects of your export sale. The first point is to consider the geographic distance involved. What are the logistics behind the export sale? Do the goods require any special packaging? Do the goods need to be shipped in certain shipping conditions? For example, maximum temperatures to meet health certification requirements. Local customs and duty. Have you researched the local market sufficiently? Are there local taxes and tariffs you need to know about? Is it a market where it may be better to work with a local agent or even perhaps a joint venture partner locally to help you to develop and sell into the new market? In some overseas territories, such as the Middle East, the importer may well require your shipping documents to be legalized by their embassy. So you should make sure to build in time to cover this to make sure you can comply with the BAR's requirements on this aspect. If you're selling outside of the EU, VAT will not apply on the sale. So does this impact on immediate term cash flow where you pay VAT on purchases before the sale crystallizes? And then what about the freight costs and goods insurance? Who's to cover these costs, and are those costs reflected in your terms of sale? We're exporting food and or food ingredients. I think important to underline to make sure that your product will not cause offence on cultural and religious grounds in respect of the market that you're selling into. So if we could go to the next slide, please. So having researched your overseas market of choice, you now turn your mind to financing the new opportunity, and rightly, you look to your bank manager to help. Where you trade internationally as either importer or exporter or both, your bank will have specific products and solutions to help manage and finance your international trades. As you can see, this slide shows a pyramid. To us though, it's a ladder, or more to the point, we call this the trade risk ladder. And what it does is to set out the various ways you can buy and sell as either an importer or exporter. So essentially, a risk ladder, why is that? Because what is good for the exporter is not so good for the importer, and vice versa. So to take this from the exporter's viewpoint, best case is to sell cash in advance, of course. Best scenario for the seller, and understandably, worst case scenario for the buyer. In some cases where the relationship is new, you may, as the seller, require cash in advance, and through this will help to build up a good track record and relationship with the buyer. Not so good as cash in advance for the exporter, but next best, we would argue, is to sell against prior receipt of a confirmed letter of credit. LC confirmation means your bank in the UK assumes the payment obligation to the exporter, and in order to claim payment, the exporter must present a compliant set of documents. Whereas unconfirmed, this will mean that the seller, the exporter, is taking the buyer's bank payment risk. So some of you may be well versed in letters of credit and how they work, but for those dialing in this afternoon that are not too familiar with them, a simple definition of a letter of credit could be that it represents a conditional promise of payment made by the buyer's bank to the seller. This promise becomes an actual payment once the exporter presents compliant documentation under the LC. The payment obligation is irrevocable on this basis. We would argue that the LC is a good and secure way for the exporter to sell. It helps mitigate key selling risks of buyer non-take-up of goods and their non-payment or inability to pay for them. And would argue equally that because of this, to sell against the letter of credit, it can help support the case, the business case, if you're looking for working capital options through the bank to help support your export sale. Moving down the ladder, we come to collections. Less secure than a letter of credit, as we would view it. Firstly, we have documentary collection payable at site. A documentary collection is not an irrevocable payment undertaking in the same way the LC is. And the collection, what it is, it contains all of the original shipping documentation along with your sales invoice and your covering schedule. You then present those documents, your collection, to your bank, who sends them to the buyer's bank to claim and collect payment for you. With the collection, important to note that the buyer has the option to decline the acceptance of your shipping documents. But we would say that the collection is more secure as compared to, say, open account. Why is this? Because the buyer's bank will act as custodian of your shipping documentation. The exporter will retain title to the goods until the collection is accepted and paid for, in this instance at site, by them. So the next rung on the ladder, working through the risk ladder, is where you sell, again, documentary collection, but this time with term payment. Less secure, why is this? Because you're giving terms to the buyer, and you're therefore taking buyer payment risk and relying on them to meet the payment obligation at the term maturity, for example, 30 to maybe 90 days after shipment date. With the term collection, you do have the option to request that your buyer's bank adds its aval to your term collection. What this means is that you're asking your buyer's bank to guarantee payment to you at payment maturity, and in which event you're taking buyer's bank payment risk, not buyer's payment risk. So again, in respect of the risk ladder, moving on to open account, in respect of that, a less secure way to sell than as compared to collection. Of course, the buyer will already have the goods before paying for them, and this therefore means that the seller has payment risk and the buyer non-take-up of the goods themselves. Noting the selling risks, and in order to compete, you may feel that to trade open account, you're happy to do so. This might be where you have a good relationship with the buyer and they have a good payment history with you, like always paying on time. It could be that you're supplying a major enterprise with a strong credit profile, so feel relaxed about the payment risk. And as we heard from Susan earlier, there is help available to exporters, to SMEs, in respect of bad debt credit protection options in the market to help mitigate buyer payment risks. If we can move to the next slide, please. So on this next slide, I just wanted to run through a little more detail around the workings of an LC and just to briefly revisit collections. First point is that when you receive the LC, it is important to check the details. Do those details match and reflect what you've already negotiated with the buyer? For example, amount, currency, Inco freight terms such as FOB, CIF, who pays freight and insurance. Are you confident that you can meet and comply with the terms and requirements of the letter of credit? So having checked the LC, you may notice that changes are required. It's best to raise this early on with the buyer. And a point to bear in mind is that it is only the buyer, or they're called the applicant in the LC, who can agree and then instruct their bank to amend the LC with the changes that you want and need. Overall, where you sell by LCs, a key point to underline is that to encash the LC, it's all about the correctness of your shipping documentation. And a key message for me is to try to ensure as far as possible that you will be in a position to effect a compliant documentary presentation. Just to revisit collections very briefly, I talked on the last slide about the risk of the buyer declining your documentary collection. To help in part mitigate this, and where possible, try to have a viable secondary sell down option available to you in the event that you do need to redirect those goods to another buyer and hopefully attain best price basis. Thank you, Gemma. So this next slide is really to highlight the cash implications of your export trade. We see it that there are two phases, pre-shipment and post-shipment, which make up what we call the trade cycle. And as you can see, potentially this could extend to some 180 days, in some cases longer, and will clearly tie up cash flow for this period. So when you plan your export sale, do you have the right working capital solution to cover this, both on a pre-shipment and a post-shipment basis? On the slide, you'll see that the pre-shipment phase will cover the period from receiving buyer's order. Next step would be to mobilize production and or purchases, and then to collate and present shipping documents to the buyer's bank to claim payment. This then brings us to the post-shipment period, and as we saw from the risk ladder, what are the terms of sale? How long is it before you can bank the receivable? And I'd like to stress, as a last point on this slide, always best to speak to the bank early on about your planned export trades. The bank will have product options and solutions to help manage your trades, and also working capital options that may be available that they can talk to you about. Next slide, please. And so this slide has details about bonds and guarantees. Acknowledge fully that for many food and drink exporters, there may not be a need to offer bonds and guarantees to your buyers, but if you are competing for larger contracts, they may apply. What are bonds and guarantees? Well, they're financial instruments that your bank can help with. They are in effect on-demand guarantees given to the buyer by your bank to guarantee the exporter's performance to carry out and complete the contract. In terms of food and drink exports, where might they be seen? A scenario could be, for example, that you've won an ongoing contract to supply on a rolling basis goods that are critical to the day-to-day operations of the business that you are supplying to. The buyer wants reassurance that you can perform and complete the supply program. A performance bond issued by the bank may deliver the solution. Just to briefly run through the types of guarantees that may be required. Performance bonds issued by your bank where they are required by the buyer, designed to guarantee the exporter's performance obligations under the contract, and typically in terms of value-wise could represent 5%, perhaps 10% of the contract value, and they would run for the duration of the contract. Advanced payment guarantees apply where the exporter requires advanced payment monies to mobilize works, purchases, work in progress. The buyer might well require an advanced payment guarantee for the value of the advanced monies to ensure that the guarantees the exporter's performance is guaranteed. If we turn to the next slide, please. I wanted to briefly mention our work with UK Export Finance, UKEF, where we have exporter customers competing to win new export contracts opportunity. And this slide gives some details behind the export finance schemes operated by UKEF and how we work together to progress qualifying transactions. I won't go into further detail at this point. You'll hear more information about these schemes from my co-presenter Paul from UKEF, who will be speaking to you shortly. So this brings me to my last slide to talk about foreign exchange. Where you are buying and selling in foreign currency, please do consider the foreign exchange risks in the transaction. Are you sufficiently protected against adverse movement in the currencies that you're dealing in? The bank can help you to in part mitigate this risk through forward exchange contracts to help ensure that you can lock into your hard-earned transactional profit. Better still is where you have what we call a natural foreign exchange hedge, where the bank can open accounts in the currency where you are buying and selling in that same currency. So this completes my presentation. Thank you for listening. I hope of interest and informative.
Thanks, Mark. Yeah, it's from one extreme to another there, wasn't it? From the nirvana of cash in advance, which would be a dream come true, I think, for most people, to 180 days for a trade cycle to complete and payment to be received. So from one extreme to the other, but let's hope your products and services help exporters through that journey. Now I'd like to hand over and introduce our final speaker, so over to you, Paul.
Okay, well, my name is Paul Wills. I'd like to say thank you to the Food and Drink Federation for inviting me to speak. So firstly, who are we? UK Export Finance are a UK government department set up in 19 as the UK's export credit agency. Our role is to complement the private sector. We don't compete, and importantly, we aren't a subsidy. We support exporters of all sizes and sectors, including the food and drink sector, and we'd like to see more inquiries from the food and drink sector. Our business group supports the likes of Airbus and Rolls-Royce, but in recent years we've established a trade finance and insurance solutions group for smaller exporters, medium-sized exporters, and exports on payment terms below 730 days. Our trade finance and insurance solutions group has supported over £1 billion worth of contract values in the last 3 years. And along with the theme of this webinar, a lot of these are businesses who are scaling up, so they're looking into new markets or they're going through a period of high growth. Next slide, please. Sorry, the slide after that. So what do we do that may be relevant to you? We provide guidance through our regional network of export finance advisors. Where you can't obtain it from the private sector, we provide trade credit insurance to exporters against the risk of their buyer not paying under export contracts outside OECD-rich countries, with a few exceptions such as Greece. And we provide guarantees to banks to support working capital financing and raising of contract bonds on behalf of exporters. Next slide, please. So today I'm going to focus on a few case studies in respect of our trade finance and insurance solutions. I've chosen this first case study because it's a good comparator to the food and drink sector. So what do you do if you use credit insurance, but you suddenly lose your insurance cover against your buyer not paying due to market turbulence? GR Lane came to us. They're best known for their products, the cold relief mixture Olbas oil and the herbal sleep aid Calms. GR Lane's been selling goods to its Greek buyer worth around £700,000 for around 20 years, but its private insurer decided that the Greek economy had become too risky and declined further cover. Greece was an important market for GR Lane and steady. They had £1 million policy for the contract, but this was reduced to £750,000 in 2011 and withdrawn in 2012. They secured a few orders in 2012, but on a cash up-front basis and only a quarter of their usual size. This affected their trade and their relationship with their buyer. So what did they do? They approached UK Export Finance for an export insurance policy, or EXIT, which insures an exporter against the risk of their customer not paying, for either buyer reasons or political ones. An EXIT can cover up to 95% of the contract value. In October 2012, we offered GR Lane an exit covering up to £570,000 for risk against their Greek buyer being unable to pay. Exit cover started in December 2012, and GR Lane pays the premium every time it sends an order to Greece. And this arrangement will continue until private sector insurers consider Greece to be a good risk once more. We've been doing the same for a UK cheese exporter who also lost their private sector credit insurance for Greece. So you can see that many exporters are considering trade credit insurance as a way that they can get comfortable with the risk of continuing to offer open account terms to their buyer. And that's a really important thing to consider in terms of the risk ladder, is how you can do something which is very advantageous to your buyer, but making that risk acceptable through using the tools which are available to you. Next slide, please. So again, I'm sorry this isn't a food and drink case study, but hopefully we'll get some more food and drink case studies as a result of this webinar. This hopefully explains how a company can manage the impact on their working capital of asking their bank to issue advance payment guarantees and contract bonds. So what do you do if you win an overseas contract, but the advance payment guarantee you need to offer threatens to restrict your working capital? Micron Sprayers came to us. Micron Sprayers has been selling its specialised agricultural equipment since 1956. It exports to more than 100 companies worldwide, with 90% of its sales coming from overseas. In 2013, it won a 1.2 million contract to supply a French cotton producer with sprayers for its small-scale cotton farmers in Cameroon. They've negotiated a 40% advance payment to fund the purchase of components, but it needed its bank to issue an advance payment guarantee. So going back to the risk ladder, they're getting their down payment, which is comfort to the exporter, but their overseas buyer says, well, if I'm going to give you an advance payment, how do I know that you're not going to go bankrupt in the meantime? The one who knows best whether you're going to go bankrupt, the exporter, is your bank. So if your bank is willing to issue an advance guarantee on your behalf, that gives the overseas buyer comfort that you are a good risk to do business with. Micron Sprayers had an existing £1 million working capital facility for overdraft and bonding with its bank. However, the advance payment guarantee would have used most of this up. This would make bidding for and accepting other export contracts difficult. So Micron Sprayers approached UK Export Finance for help. Now, Micron Sprayers could have covered the Cameroon bond from its existing line of credit with its bank, but by doing so, the company wouldn't have been able to take on any of the other work that it was looking at in Africa. So you can see it may not necessarily that all your bank facilities are used up. It may be a factor around your growth potential as a company, making you look hard and carefully discussing with your bank how you're going to achieve your future growth plans. From our discussions with banks, you do have to be very clear to your bank. If you have significant growth plans, speak to your bank, present them with your plans so that they can have an idea of what you're looking for in terms of your growth. The more you share a detailed business plan, your management information, your business strategy with your bank, the more likely it is that they'll be able to advise you on what may be on offer. And if necessary, that may include our support. But it may be if the bank can get comfortable on its own with your growth itself, then it can take all that risk itself, and that, of course, is ideal for the taxpayer. In this case, UK Export Finance worked with Micron Sprayers Bank to open up another line of credit specifically for this customer. We guaranteed 80% of the liability under our bond support scheme, having looked at the UK exporter's balance sheet, and the bank took on the remainder of the risk. As the £1 million facility with its bank was left untouched, Micron Sprayers was able to bid for new contracts in Africa, confident it could cover further bonds. So you see, this is how the exporter was using what's available to actually pursue its increased growth. UK Export Finance's support, therefore, has enabled it to bid for new contracts in Africa, and it also managed to renew its contract with the buyer in Cameroon in December 2013. Next slide, please. A Again, apologies, this isn't a food and drink case study, but it hopefully explains how a fast-growing company can manage the impact on their export working capital of taking on larger export contracts. So what do you do if you want to take on an export contract, but it would tie up your working capital? Edutech came to us. They provide educational equipment and consultancy services to schools and vocational colleges in developing countries like Rwanda. They can turn an empty room into a training workshop or GCSE level classroom, and they had a turnover of £3.5 million in 2012. In January 2013, they won a contract almost equivalent to their annual turnover to provide schools and colleges in Eritrea with training equipment and consultancy services. Their client, the African Development Bank, needed a 10% performance bond before work could begin. Although Edutech could secure the bond itself, the £340,000 bond required would leave them unable to take on other work. So again, in terms of the risk ladder, they're being required to provide a performance bond to show as a company that they're able to perform this contract. But if they do, it may leave them unable to provide competitive financing for their future export growth. And they have to deal with this challenge as a company and decide what the options are by talking to their finance providers. So for each new contract, they had to buy the equipment whilst looking for more work. Edutech said they'd be taking too many risks by tying up their capital in this one bond. And many companies that we deal with have exactly the same issue, that if they have the big contract, which will help provide significant growth for their business, a breakthrough in their export markets, whether they be developed markets or emerging markets, if they take this on, they may consider it's too large for their company to swallow and they may walk away from it. Or they may think that they can only take that business on if they stop doing their future development. And that is a real challenge for UK exporters, and one which we've been trying our best to work with the banks to unlock. Because if you have the solid growth potential within your business and your company can deal through your balance sheet with a period of rapid growth, then we want UK companies to be achieving that growth rather than feel that they don't have any options, that they are taking a choice between, can we take this, is it too big, is this having all our risks in one basket? And of course exporters don't want to feel that, and quite rightly so. So this is a solution to try to help people not feel they're putting all their eggs in one basket, that they can grow in a balanced way. So in this case, the bank was unable to increase the working capital facility, so they came to us for help. We agreed to guarantee half of the performance bond through our bond support scheme, with the company's bank agreeing to guarantee the other half. We also agreed at the same time to guarantee half of the bank's working capital facility through our export working capital scheme, and this enabled the bank to double the amount available to Edutech. So as a result of this help, Edutech had enough working capital to start the Eritrean contract, and they could also accept 2 new contracts in 2 new export markets. So the company tripled its turnover in 2013, and it's now looking to do work elsewhere in Africa and also in Southeast Asia. Next slide, please. So how do you access our products? As I said, it's very important for our bank-based schemes that you're speaking to your bank, that you have a dialogue about your plans. Your bank hopefully will be in a position to meet those themselves. If we are involved, then you approach us through your bank, and there'll be no additional fee from UK Export Finance for your application. In terms of our insurance policies, you can approach us through an insurance broker. We have a list including Susan Ross at Aon on our website that you can find, or you can apply to us direct. Again, there isn't any charge related to that. We of course charge a premium in relation to the risk. We're continuously improving our product delivery to try to improve your customer experience, and we value feedback from our customers and our partners. And I think the likes of Susan, who has worked with us for a number of years, and RBS, hopefully the feeling is that we're on the right path to doing that. As I say, we have now crossed the £1 billion worth of contracts supported in this area, which is a big growth for us. So next slide, please. We have, as I mentioned, our export finance advisors. We have 17 of these around the UK now, and this will rise to 24 soon. What do? They assist exporters, banks, insurance brokers and intermediaries with advice and guidance on our products and services. They assist exporters with applications for UK export finance support and liaise with the banks and insurance brokers as necessary. And they provide guidance to exporters in accessing private market trade finance and credit insurance and provide suitable introductions. They also provide free assistance and guidance. So it may not necessarily be that an exporter needs a banking solution. They may not need a UK export finance solution. Sometimes, depending on their stage of growth, they may need to look at other solutions. So part of our value added, if you like, is that we may be able to say, this isn't something that you're at the right stage of growth for your bank to be dealing with. It may be somewhere else within the alternative finance market you should be looking for that contract to be supported. So that can be a time saver for you and can help understand where your bank are coming from if you're not getting the right noises from your bank. Next slide, please. So how do you contact our export finance advisors? You'll find all of their contact details on our website, and they are the first point of contact. You'll also find more case studies from various sectors on our website and more information on our products. So that's it from me. Thank you.
Okay, thanks very much, Paul. It's fascinating insight there, particularly about the work you've done to support the exporter going to Greece. I mean, clearly that hit a lot of trouble, that market. Interested in the stuff on spreading risk, and certainly for anyone listening, it's clear that UK export finance is a resource to tap into, and I would urge you to do so. So I think we have got a bit of time for questions. Matt, have you got any questions come through?
Yeah, I've got quite a few questions actually, Steve. Can you hear me okay?
Yeah, I can hear you.
What I would say to people is if I think we were only scheduled to run to 3:30, so if you do need to duck off to another appointment, the full recording of the webinar will be up on YouTube in a few days, so don't worry, you won't miss out. And if you do have any additional questions to submit, use the question box in your right-hand control panel, and we'll do our best to get to them. And if we can't get to them within the webinar, then we'll get answers to you either in our Q&A forum or directly after the event. But Steve, yeah, a couple of questions come through. One, sort of a couple of questions on a similar theme, which was that there's obviously a cost for some of these products, whether it's insurance or some of the products that the banks can provide. At what stage in a company's exporting journey, is there a kind of a volume value type equation? Does it become sort of worthwhile to invest in some of these products?
Okay. In a sense, that's an ideal question to ask to all the panelists, but if I do it in order, Susan, do you have a view on that? At what point is it advisable to start taking insurance?
Just on my own. My view is to really think through what level of risk your company can bear, because £10,000 might be too much for some, 50,000 might be for another. And so really think through the process, who it is, and what it will mean to you. Food often is very low margin, and so therefore I would recommend buying cover sooner rather than later. Some other high value products, maybe it would take you less long to make up that amount of turnover. So I turn it back and really start buying when you need the cover for managing the risks in your business.
Is it a case, Susan, do you think of insuring what you cannot afford to lose?
I mean, I think, to me, I just think I insure my house. I insure my house because there's a myriad of things that I have thought of and haven't thought of that I want to be sure it's still there. And I think if you're thinking of insurance, well, I never get my claims paid, that's probably the wrong way to look at it. Look at it as managing risk. And so if as as a business, you don't want to have the hassle of the impact of bad debt on your business, then buy the cover because it's as part of your management stream, as a process driven.
Okay, thank you. Paul, do you have a view on this with your UK export finance head on?
The only thing I'd like to add to Susan is the tools aren't necessarily just about protecting your risks, they're also about what you feel comfortable to offer your buyer. And as I said with the GR Lane example, if you're thinking, what is the best competitive offer I can offer to my buyer? If you assess the credit of your overseas buyer, say having got a credit report, and you find that they are actually a good risk, maybe you should be considering what's the maximum I can offer them. And if that means that you're paying to have credit insurance because you believe that that will provide you with the comfort to allow you to offer the maximum possible credit terms so that you're competitive against other companies around the world who you'll be trying to break into that market who may also be looking to supply, you've got to take that into account. If you're not using all of the tools which are available, that may mean that what you're offering is less competitive than what somebody else is offering. You do have to think about that. It's not just about UK and you don't know your overseas buyer. There may be plenty of other people from around the world who may have a slightly different risk appetite to you, and you need to be aware of that.
Okay, no, I understand that. That's another competitive element to consider. Mark, banks are possibly a little more cautious than they were pre-2008. What's your view now? When is it important that you like to see your customers insuring against a variety of risks?
Well, I think firstly, back to the point I made in the presentation, really, that where you do undertake export trades, where you are looking at your forward plans to engage early on with the bank, to talk through those plans, to understand the cash requirements, the cash needs, how those solutions are going to look, to help take those opportunities forward. But I think the headline question was regarding cost of products. And I think what I would like to do suggest is really to put that back in context of how the trade solution through the bank can work for your business. And if we perhaps just turn that over to where the exporter is maybe buying from overseas suppliers or manufacturing goods, how those trade products and solutions can work in that business to hopefully unlock better terms of purchase from suppliers. So in real terms, net of those margin savings, that always has to be seen in the context of the cost of the products in notional terms. So really to stress that these products can work proactively in the business to help deliver better terms of purchase, better terms of sale, maximise margin opportunity accordingly. But again, underline, engage with the bank manager early on to talk about the plans and requirements going forward.
Okay, then, but in doing so, you'll get the best advice at the earliest stage. Okay, thank you all, panelists. Matt, is there anything else?
Yeah, picking up on that discussion, actually, we talked about, Paul was mentioning some of these products offering a competitive advantage. Are there any situations where there's actually an obligation to buyers to have certain insurance policies or products in place?
Yeah, Susan, you able to answer that?
If you're selling to certain countries, you'll find that they like to pay you by letter of credit. If you're selling to Europe, probably no. I think in terms of insurance, cargo insurance is also allied to the Incoterms, the terms of delivery. Some of them carry an insurance requirement on them. So I would say it's probably more into what's in your terms and conditions of sale for each contract, rather more than the requirements of the customer. But obviously every country is different, and for some countries you're going to have different liability issues, different health documentation, different food standards, and really that's going to affect everything that you do in your trade with that country.
But referring back to your earlier analogy, Susan, about having house insurance, but you don't have to have house insurance, do you? But you have to have car insurance. Nothing strikes you where a company would have to have some kind of trade insurance before entering into an exporting agreement with any market. There's nothing that you can think of off the top of your head? Sorry, I can't hear you, Susan.
Oh, muting. Employers' liability insurance is an absolute legal requirement in the UK, and it most likely is in other countries. So it depends how that has an impact on the way you do your business if you've got an overseas office. But I don't think in terms of trade credit insurance, it's optional. You don't have to buy it. You don't have to protect yourself against bad debt.
Okay. Anything from you, Matt? Any more questions?
Two final questions, if you guys are all right. The first was around lead time. So, say a company's got a sort of a deal and it requires quite a fast turnaround. I guess particularly in the context of some of the financial products. Is the lead time for setting up some of those products kind of consistent with kind of fairly fast sort of paced transactions, so whether it's a letter of credit or some of the other sort of products that were mentioned?
Okay, I think first of all, Paul, do you have a view on that? How fast can you move when you're under pressure to help a company get products out the door?
It depends what kind of market they're looking at. So if they're looking at somewhere like Greece, then it's usually fairly quick to obtain 3 years audited accounts for their buyer there and to take a view as to whether they're insurable. So whether it's us or the private sector, if you're looking at markets where you have financial information available, it's pretty quick. And I'd expect us to be able to do it within 2 weeks to put a policy in place. Maybe quicker. The fastest I was getting them when I was doing underwriting recently was about 4 days to get an insurance policy out the door if it was dead urgent. But if you're looking further afield, then you may be unable to obtain audited accounts, and that will be challenging whether you're looking to the private sector or the public sector, and may depend on whether you're able to get them out of your buyer.
Okay, so I mean the first thing that affects speed is the market and the level of risk potentially attached to a market that an exporter would be supplying to. In terms of working with the bank, Mark, I mean, you know, how quickly can you guys respond? Do you have different levels of priority for different types of customer?
No, I mean, each transaction is always evaluated on its individual merits and will have individual requirements. We'll always try to do our best to meet any customer time frame, but come back to the point, would stress engage early on, as early as possible with the bank manager. Ultimately, our starting place has to be the level of information that we're given by our customer. Does that sufficiently articulate what they're looking to do? Do we fully understand the transactional requirements? Do we have sufficient supporting financial information from our customer to make that evaluation? But at all times, we'll try to meet any timetable accordingly. But again, stress engage early on with the bank, and ideally have the level of information that we need to make those early views.
Okay, I mean, I think it is a challenge in food and drink because it's a very, very fast-moving industry, and our orders will come in very, very quickly. It's slightly different to, say, a big engineering contract. Speed will be important. I think it's a good question to raise, Matt. Very good.
Can I just make a comment on that?
Final one.
My dairy industry contact, what he does is he sets up all his insurances so that he knows where he can sell and to what credit limit, and then he can do his trades very quickly within that. So it's the planning.
Okay, so proactive planning. Okay, I understand that. Good point, Susan.
Last question from the audience, and sorry to put you on the spot, Susan, but obviously you talk about sort of different types of risk. What's the most common sort of type of sort of challenge or risk that you tend to see actually coming to fruition? You know, and I think behind the question is really, you know, if you only go for one product, what's the thing that you really can't live without?
Great question.
I would go for two. click my thing on. I would go for 2, and I would go for the cargo cover because it's going to come with your what the logistics company is doing for you. But I would also do payment protection because these customers are overseas. You know, you don't know when the loss is going to happen. And once you've got the cover there, you can take it to the bank and have them to give you better finance than your overdraft.
Okay, thanks, Susan. I think that's it from the panelists and myself, Matt and Gemma. So back to you.
Fantastic, and thanks everyone for your time today and the contributions you've made. Some really interesting insights came out of that. Apologies if we didn't get a chance to get to your question. We will kind of follow up with those offline. Just a reminder that you can watch this webinar back and all of our webinars on our YouTube channel, which is youtube.com/open-to-export. I know at the start of the session, we had that 41% of you that said that food and drink regulation was kind of your main barrier to trade. We do have a really great webinar on that, so I'd encourage you to check out the YouTube channel and absorb some of that great content that we've got for you. There is also the feature page, so this is kind of where the community on Open to Export comes together to support our food and drink exporters. I would encourage you to get involved with the community. We have articles, case studies, we've got upcoming events, as you can see there in the bottom corner, there's this webinar. And we really do have all the partners that we've had on the call today answering your questions and helping you with your exports, so I would encourage you to check that out. The forum, the Open to Export website is a fantastic tool for further support. So registration's free and easy. If you ever need any advice or clarification, just post your question on the forum, and the experts and your peers, similar businesses, will give you a dedicated response. Alternatively, you can tweet us using the hashtag OTE Food and Drink. The next webinar is on the 31st of July. We're going to be looking at routes to market for food and drink exporters. If you did choose the auto-enroll option, don't worry, your registration details will come out to you a little bit closer to the time. If not, I would encourage you to get onto the feature page I just showed you there and get registered for the next webinar. And I'd just like to thank you all for your time. Apologies that we run over, but I think you'll all agree we got some really good content out of the session. So thank you very much, and see you on the next one. Goodbye.